Hey everybody, this is Jay from Capio, and I'm going to talk to you today a little bit about picking winning stocks the easy way. And so, what I'm going to do is go over some specific criteria that you should look at every time you want to potentially invest in a company to determine if it's a good investment or not. So, let's jump right into it. So, how do we determine if it's a good investment or not? Well, the first step is to conduct some sort of fundamental analysis on the company in question. And for those of you that don't know, fundamental analysis is a pretty broad subject, but essentially what it has is it has you diving into the company's financials, numbers, and metrics to see if the company is growing and if it can grow going forward. And this methodology has been around for decades with people like Warren Buffett and Carl Icahn using it to make great investments. So it's not something new. But what I'm going to do today is lay out the specific criteria you should look at to evaluate companies. And if the company passes most of the checks we're going to talk about, it has a good chance of being an excellent investment. So, like I said, fundamental analysis is a pretty broad subject, but what I've done here is split the subject into 5 parts to make it easy to understand and pretty quick for this tutorial. So, we have industry comparison, valuation, fundamentals, management and profitability, and finally, future growth. And so, what I'm going to do is I'll dive a little bit deeper into each of these subjects and give you specific criteria to look at so that you know exactly what to look for when you're looking at a company. So first up, we have industry comparison, which is essentially comparing the company to its industry to determine its performance. And so what we're going to do here is compare 7 key metrics that we have listed here for the company to its industry averages to see how well the company is performing within the industry. Now, for some of these metrics, you ideally want them to be lower than the industry averages, while for others, you want them to be higher. So, for example, net profit margin is how much money the company actually retains from what it makes. And obviously, a company that's retaining more of its money could be a better investment, so we want this metric to be higher. On the other hand, price to free cash flow is a ratio of the stock price to how much free cash the company actually has. Now, typically, if the ratio is low and the company is sitting on a lot of cash, it could be what we call is undervalued, meaning there's room for the stock price to grow. But on the other hand, if that ratio is low and the company doesn't have a lot of cash, there could be something fundamentally wrong with the company. So it's always best to dig a little bit deeper into the data. And now there are a lot of other metrics we could go into, and I'll come back to those in a bit. So second, we have valuation. And what we're doing here is comparing the company to its top competitors to see if it's fairly valued and if it's a strong performer. Again, we're comparing 10 key metrics listed right here, where we want some of them to be lower than the competitors while we want others to be higher. So let's go through an example. Revenue is the amount of money a company actually receives in a period of time. And here we obviously want this number to be higher than its competitors. Same with quarterly revenue growth, meaning how much the revenue has grown since the last quarter. On the other hand, PEG, which is price to earnings growth, is another metric you ideally want to be lower than the competitors, typically around 1.0, suggesting future growth. Anything with a negative PEG is something you definitely want to stay away from. So in this case, BlackBerry is a terrible long-term investment, and there are a lot of other metrics we can go into, and I'll come back to those and touch on those in a minute. So next we have fundamentals, or how the company has been performing in the past. And so what we do here is take a look at the big three financial statements, which are the income statement, balance sheet, and cash flow statement. And so the first thing we do is we can check the income statement and specifically the revenue. So has it grown over the last year? How has it performed quarter to quarter? For Apple, in this specific case, it looks like it's fluctuated a bit this past year, but that occurs because of holiday seasons or new product line extensions. There's a multitude of reasons. In addition, this is just the last year, so if you were to look at the last 5 or 10 years of Apple's revenue growth, you'll see that it's skyrocketed. So this doesn't mean much in a grander scheme of things. Other important things to look at on the income statement are net income. We can go to the balance sheet and check out the current ratio, which is a ratio of the total assets to total liabilities, and this signals how quickly a firm can pay off its short-term debt. In addition, we can check the free cash flow and the cash flow statements to see how if it's increased over the last year and how much cash the company is generating quarter to quarter. Now, for management and profitability, we want to make sure that the management team is doing a good job of handling the resources that the company has. And so to do this, we take a look at these 4 metrics to give us a good understanding of that. It's a very high level view of the company. So what we're doing here is checking if these numbers fall into an acceptable range. And what I mean by that is for return on equity and return on assets, is it above the industry averages and has it grown since the last year? And the same goes for margins. Are they falling it somewhere between the industry averages and again, have they grown since the past year? And so lastly, we're going to take a look at future growth. Now, this one's a little bit different from the others because there isn't a specific formula that we can use to determine this. Determining if a company is going to grow going forward is pretty subjective. So this is where reading news and keeping up with current events is pretty crucial. So you have to ask yourself questions like, will Apple sell more iPhones in the next year? Or will the Apple Watch help drive sales? And more importantly, why? And so that's it. Here's a recap of all the criteria we just went over. And so if you stick to that process and evaluate every company that you might want to invest in according to these criteria, then you have a great chance of becoming a good investor. And it seems like a lot of work, and it definitely is. Finding all the data, analyzing it, and finally coming to a conclusion can take days, if not weeks. But that's exactly why we built Capio. And so Capio is a free online site that essentially automates everything we just went over. So instead of you having to manually find all the data and read through it, Capio will give you a buy, hold, or sell recommendation in literally seconds. And so what you see here is the Capio report for Apple. And right away you see it has a buy recommendation with an even composite score based off of all the criteria we just went over. It also has a target price, so you have a good idea of what kind of returns to look for. Um, and so we can click into the rating box to go even deeper into it. So in this case, when we click on the rating box, we'll see other analyst ratings from professional analysts like UBS or Barclays. And again, for Apple's, our Capio recommendation aligns with most professional analyst estimates, so there's some credibility to what we're saying here. Now, say we were looking at a brand new company, we had no idea what the company did. You could click on the description box to get a good understanding of what a company does, what sector it's in, how it makes money, and what kind of products it's selling. Since it's Apple in this case, we don't really need to read this whole thing, but it's a good tool to have. In addition, Capio aggregate the top competitors for whatever company you're looking at. So right away, we know Apple is competing with BlackBerry, Google, HP, and again, this comes in handy if you're looking at a new company. And so what Capio does is it breaks each analysis down for every company into the four sections we went over earlier, giving you composite scores for each section too, and it color codes each box, green, yellow, or red, so you know at a glance how the company is doing in each regard. Um, and so for the industry module specifically, we can click into the box to go deeper into the data, and this is the same screenshot you saw earlier. So when I said we'd come back to touch on those other metrics, what you see right here is when you hover over a metric and you might not understand what it means, Capio will give you a good definition of what it means, how it's calculated, and whether you want it to be higher or lower than either the industry or its competitors. So it makes Capio a very interactive research tool. You don't need to know what you're doing to come and use Capio. In fact, it's built for beginners. And so going into valuation, you see the same type of layout. Capio aggregates its top competitors and all of the data automatically, and it'll give you definitions while you're scrolling over the metrics, so you know exactly what you're looking at. And now you can jump a little bit into fundamentals. We talked about how Apple's revenue has been fluctuating over the last year. It's not a big deal because, again, Apple makes more and more money every year. We can scroll down and check out the net income, and it'll graph it for us. We can jump around from the balance sheet to the cash flow statement. And here we see Capio has determined that Apple's sitting on a lot of free cash, so that's a positive thing for Apple's fundamentals. So it's a good check to have. And lastly, we can jump into management. We talked about the four metrics that we want to look at a high level here. And again, if you don't know what they mean, there's great explanations on the right side of what return on assets is or what the operating margin is. And so you can come in and understand what you're looking at right away. Last thing we talked about was looking at future growth. And so another useful thing that Capio does is it automatically aggregates all the top headlines for the company you're looking at from different sources across the web, so you don't have to jump from site to site. And in addition, it has a market sentiment tab, which is powered by StockTwits, so you can go in and see what other investors are saying about the company that you might be interested in investing in. And so in this case, we're seeing that somebody's saying Goldman Sachs reiterated their buy rating for Apple and set a price target of 151. So that's pretty useful information to have. And so that's pretty much it, guys. I went over a lot of the criteria you guys should be looking for when investing in new companies, as well as how to do that specifically using tools like Capio, which makes it a lot easier. And if you have any questions or comments, feel free to shoot me a tweet or shoot me an email. And go check out Capio today and start making smarter investments.